reports.
When the US sneezes, the rest of the world catches a cold, or so the saying goes. But as the US economy regains its vigor, developing markets are shivering. A key index of emerging market share prices slumped for the 9th straight session today. Only twice in the past 20 years has the FTSE Emerging Index fallen for longer. The problem? The robust US economy no longer needs the special care of the central bank, otherwise known as quantitative easing. At a 2-day meeting this week, the Fed is expected to signal that interest rates could rise, maybe soon. That increases the return of dollar-denominated assets.
I think we're just at the beginning of a long-term dollar uptrend that's going to last for several years. The divergence in monetary policy globally is really striking, and the U.S. is in the forefront.
Add in geopolitical tensions, turmoil in the Middle East and Ukraine, and the U.S. dollar looks like a safe bet in an uncertain world. Growth has even begun to falter in China, previously the powerhouse of the developing world. Recent economic data point to a worrying slowdown, and many economists fear the Chinese economy will fail to meet the government's growth target of 7.5% this year.
But ultimately, one should expect China to slow because the central government is allowing the biggest domestic sector in the Chinese economy to correct, which is residential property.
China's weakness could be contagious. Other developing economies have grown richer by exporting resources to Chinese factories. But now the emerging markets are beginning to pale. And with the dollar on the rise, developing market recovery could be some way off. Laurie Laird, Arise News.
Joined the studio now by Yannick Naud from Sturgeon Capital. Let's talk about the dollar first of all, because it seems to centre around this, doesn't it? I suppose the question why the strength is a pretty obvious answer, isn't it? But it's something you've been saying for quite a while.
Well, I mean, the dollar is stronger because the Fed will be probably, as well as the Bank of England, the first central bank to increase interest rate. And therefore, and on top of that, you have, I mean, one of the reasons of that is you have very strong economic numbers in terms of growth, in terms of reduction in unemployment. So it makes sense, it's logical for the dollar to get stronger. Obviously, when the dollar gets stronger, as we have seen in the past, it's not always very good for emerging market currency and emerging market at all.
Now, when the dollar was relatively weak, and again, you talk about these terrible generalities, but let's just bear with it for the moment. People would actually look at the emerging markets for the risk and return and so on and say that's okay. And I know they're not a homogeneous zone either, so we can talk about that in a sec or two. But is it now almost inevitable that money will, as the UK and the US particularly, start to tighten, that money will start to come back?
Well, it's very possible. I mean, the investor looking for yield. If you can get a better yield, better return on your investment in a developed market, it will be logic for the money to be invested in developed market. Having said that, you have to keep in mind that those markets have been rising this year. I mean, for example, even South Africa, that was not the best market, I think is up 10% this year. India, on the back of the election, is up 25% this year. So those markets had a very, very good run, even after the correction that we have in the last 2 weeks.
Let's dissect that homogeneous zone, if you like, and let's talk about the fragile five first of all. You mentioned South Africa. Do you suspect money flowing out of those first of all, and if so, what effect will it have on them?
Usually, if your currency is weaker, it is better for your country because it makes you export cheaper. The problem with the fragile five is the fact that they have a lot of inflation as well. So if the currency is starting to get lower, to get cheaper compared to the dollar, they will have higher inflation because they will import goods in foreign currency. And the central bank will have to increase interest rate, and that will risk to choke the economy again. So that we have seen previously last year, for example, in Turkey or in South Africa, or even in Brazil, even in India at the time. So that's really the real risk. The economy by itself is quite fragile, and therefore every move has to be very subtle to make sure that it doesn't choke entirely.
So they suffer internal problems and external pressures as well. Okay, let's talk about the cyclical recovery group, as you described.
Yes, Basically, so you have different the type of country. Some country have a good balance of payment, and they are exporting their way in terms of recovery. Or they are benefiting from the fact that they are very strong neighbor. For example, Mexico is fully benefiting from the fact that U.S. is growing very, very strongly, and they can attract capital, they can export into the U.S., and therefore, if their currency is getting weaker against the dollar, that's a good news for them because they will be able to export more. You have other countries like this. In fact, most of Asia, Far East and Asia, is in this kind of category. They have positive balance of payment.
Very briefly, what do you expect from the FOMC meeting tomorrow in the United States?
Well, I think we will have subtle difference in terms of how to announce the end of the tapering that should stop in October, and when will be the right condition for an increase of interest rate. We all know that there will be an increase of interest rate. Right now, we don't know if it will be towards the beginning of 2015 or towards July of 2015. It does make a difference because if the rise of interest rate is quicker than expected, we will see some movement in the market.
A decoding job as usual. Thanks so much indeed.
Thank you.
Do stay with us, Yannick, for the moment.